Okay, so I'm Professor Ismael Rico, and I will be the online learning coordinator for FMGT6351, which is the business finance for the batch 2 semester. And today, I'm going to discuss the week 6 of your topic in the LMS, which is the sources of funds. Okay, so the week 6, the topic in your LMS in week 6 is the sources of funds. So we have to discuss here the financial resources that needed in order to operate the business and to what? To circulate the cash flow and to cover up all the liabilities and expenses and earning profits for the business expansion. So our learning objectives is to know the financial requirements of the business. When we say financial requirements, what are the financial resources needed in the operation of the business, and to enumerate and classify the common sources of financing. From the word itself, finance, it talks about money. It talks about a resources that needed in the operation of the business. And when it comes to financing, or when it comes to money that we need use for the money needed for the operation of the business, we have a lot of sources that we're going to use as capital and investment. Okay, so let us discuss now the financial requirements. Financial requirements was divided into two, which is the fixed capital requirement and the working capital requirement. So what's the difference between the two? The fixed capital requirement, those are the investment or the financial resources which is in the form of fixed asset that can be used for a long period of time. Okay? When you say fixed assets, it talks about in kind, or it talks about an object that can be used in the operation of the business and there is a lifespan. An example of that fixed capital requirement is machinery, equipment, land, and building. Even though these are the properties, those things have their values or the amount which they purchase that can be used, and it should be recorded in the books of accounts, the values of those fixed assets. Well, the working capital requirement, this is, it talks about cash or current assets. Say, current assets, those are the assets which is convertible to cash within the short period. And the working capital requirement, it talks about holding of current assets. When say holding, it talks about managing and controlling it in order to sustain the expenses. Okay? An example of those expenses, of course, this is an accounting term. It talks about the salaries, wages, taxes, and rent. Those expenses should be covered by the working capital requirement, which is the current assets. And those current assets which is convertible to cash are the inventories, the accounts receivable, and what? And even the cash on hand and the petty cash on hand itself. So those are the financial requirements. We have the fixed capital and the working capital. So the next is the common sources of funds. So we have the following common sources of funds. We have the equity shares and the preference shares. Equity shares, it talks about a common stock or a security that represents the shareholders' fraction ownership in the corporation. Say fractional, a portion of ownership in the corporation. In order to be a shareholder, you should have a stock or security that can be invested, and that is the equity shares. While the preference share is also an equity share or a stocks in the form of preferred stock, okay, which is offered from general public. But the preference stock or the preferred stock or the preference shareholders, they are paid first for the dividend declaration, especially in case of liquidation. But this kind of preference share has no voting rights to elect or to appoint a chief executive officer or chief operating officer of the company. While the common stockholders, they are the ones who have voting rights. Okay. Next, retained earnings. So a retained earning, this is a profit of the stocks. Because the profit of the stock, when they paid out those profit, it will call it as dividends. But if those dividends are not paid out for the declaration of the corporation, it is not, we say not paid out, but this kind of profit will be used in the expansion of investment, that will call it as retained earnings. Okay? So retained earnings can be a reserve for the expansion and development of the corporation or the business itself. Debentures. So what do you mean by debentures? Okay, a debenture, this is a debt instrument that companies or large company will borrow money with a fixed rate of interest, and the only collateral that can be backed up is the creditworthiness or trust or the reputation of the owner or the business that they assure to pay it. Oh. An example of debenture, let's say SM Corporation. SM Corporation has also a debentures. They also borrowed money from the bank because what they only have is the reputation as the company image itself. Because they believe, because the banks or other financial institutions believe that SM is a corporation that has a capacity to pay that loan with a fixed rate in the latter, because this kind of loan borrowed by SM can be used for the expansion. As you can see, SM Corporation has a lot of expansions and there are a lot of diversifications, right? Another form of a common source of funds is the loan from the banks and financial institutions. So it talks about borrowing money to the bank. And what are the other financial institutions? It talks about credit union, pawn shop, lending institution, insurance corporations, okay? Those are the other financial institutions, okay? So why is it that loans can be also form of funds? Because they borrowed money that can be used for the investment and expand of business operation, and we're going to pay back this kind of loan or the borrowed money with an interest. Another also a source of fund is a public deposit. So a public deposit, okay, take note, the company should raise funds to encourage investors to invest and deposit their investments to the company. And the rate of interest on deposit is usually higher higher than the bank offerings or other financial institution. What we call it as public deposits. The company can raise funds that encourage investors to invest for them. Another form is a lease financing. Okay, lease financing is a contractual agreement, okay, which a party owning an asset. So what the meaning of this financing is when a company is going to rent, so lease is a rent a particular fixed asset, of course it can be used for them and they're going to pay it based on the period. Example of this financing, Xerox machine, let's say. Okay, the company does not buy a Xerox machine, but they only do a lease financing because a Xerox machine can be depreciated and it will be easily depreciated. What the company is going to do that is they rent a photocopy machine to the photocopy companies, and they're going to pay for that kind of service with a fixed term. Let's say the photocopy machine can be used or to lease for 2 years. So it's just like a rent. So you have so the company who lease finance the photocopy machine, they're going to pay it to the photocopy machine company. Okay, there is a period of payment. Not only applies to the photocopy machine but to the equipment and machineries. And usually, equipment and machineries is in the form of this financing, especially if the companies doesn't want to invest for their own machines, but they only to rent. Okay. Next is the trade credit. Okay, the trade credit, this is an unsecured loan or a secured liability, because a trade credit, it talks about purchasing of supplies in a form of credit. Okay, say purchase of supplies in the form of credit. It talks about accounts payable. Okay. there is a specified period of time, especially if it is a short-term credit, it should be paid within 1 year period. Okay? You are only purchasing raw materials or supplies by means of terms that we form as, that will be called as trade of credit, a trade credit. Factoring, okay, factoring, this is a financing method that a business owner, they're going to sell their collectibles at a discount to a third party, which is financing to raise capital. What do you mean by that? Factoring. Let's say you have uncollected receivables. So these uncollected receivables, you're going to sell it to other companies or to a person where you sold it in order to recover up your losses, and this kind of the buyer of the collectible at a discount be the one to collect that kind collections of to the customer. You know, factoring is a very high risk of source of funds. Why? Because if you're going to sell the receivables, which is in a form of bad debts or uncollected, it's a risk for the buyer or who will buy this kind of receivable, that it is very what do you call this, higher risk, because you, even the collectibles are bought by the company or by a customer itself, but the question is this kind of bad can be recovered and collected to the customer. But in a sense, the company who sells the receivables at a discount, they can be also used as the raising a capital or a source of fund for the business operation. And the commercial paper, it talks about unsecured promissory note. I believe commercial paper is not applicable anymore for the source of funds. There are some companies who do that, but because we are now in the modern times, commercial paper is not circulated, but it is, there are some companies or banks that they also practice that kind of source of funds, because this is an unsecured promissory note or a promise to pay for a short-term debt obligations. Okay, so those are the sources of funds. So we have also the classical classification of source of funds based on the period and based on the ownership. So let's discuss first the based on the period. So the classification of short-term funds based on the period, we have the short-term, medium-term, and the long-term. The short-term source of finance, these are the short-term finance that required for not exceeding 1 year. So it talks about current assets. Make sure that this kind of finance must be converted to cash within a particular period of use or in a short-term period. Example of that is the petty cash. Okay, it should be replenished for a short period, so we can circulate or we can reserve an investment in order to cover up some expenses and liabilities in a short period. While the medium-term source of finances, these are the finance that required for more than 1 year but less than 5 years. So we are talking about here the fixed asset and the equity shares or the cash investments or the capital investments. It's a medium-term source of finance. While the long-term source of finance, those are the finance required for the period of more than 5 years. So a company must maintain a large capital investments in order to operate it for a long period of time, or especially for more than 5 years. Okay? And we have also the classification of finance based on, classification of source of funds based on the ownership. We have the owner's funds and the borrowed funds. So the owner's funds, those are the funds, okay, take out, that provided as proprietors, meaning investment or the cash on hand or the properties which is going to use as the investment for the business at their own pocket of the owners. Take note, own pocket. If you want to invest a fund for your business at your own pocket that we call it as owner's fund. While the borrowed funds, you're going to borrow money from a bank or for other institutions that can, and that money that should be borrowed can be used as investment, and that we call it as liabilities, or shall we say debt financing. And what is the base of the funds based on the generation or source of generation? We have the internal sources and external sources. The internal source of funds, those are the funds generated within the business, and that is the profit itself. That is in the proper performance of the business. While the external source of funds, which is generated outside an organization. And what's the example of external sources of funds? Let's say securities that you're going to buy and sell to the public. That can be external sources of funds. What they call this? Rent, which is not part of the major income. So that will be external sources of funds. Okay? So that will be the sources of funds. And that will be the topic for week 6.